Hey, Andy here. Wanted to talk about some possible alternatives to consider in place of bonds in your portfolio. So bonds, a typical portfolio has historically been part stocks, part bonds, a traditional portfolio. And bonds were widely viewed as the safe-ish and stable-ish portion of the investment of the portfolio. And some people mistakenly think bonds are risk-free. Not the case, never was the case, but bonds generally have done fairly well, with positive returns in most years. Now, early 2022, a lot of bonds and bond funds are down quite a sizable amount. It's the worst year-to-date start in, I think, like 40 years. And that's a function of interest rates have gone up a lot in a short amount of time. I'll save that for a separate video, but all else equal, as interest rates rise, bond prices fall and vice versa. So interest rates have risen a lot in a short period of time. So bond prices have really gotten, pretty pressured in recent months. So that leaves a lot of people wondering, well, what are the alternatives to bonds and bond funds? There's a few things to consider, a few possible alternatives, none of which are direct replacements, and they all have their own pros and cons, and I'll run through them now. I also went through this in a bit more detail in my podcast that came out today. You can find a link to that in the notes of this video. But to sum up, again, viewing bonds as not risk-free, and they're not there to make smashingly large returns, they're there to be sort of the relative stability, and relative lower risk stuff or part of your portfolio compared to stocks. Again, not risk-free, not there to make a lot of money. It's there to hopefully make some money year to year, but not lose too much when things get nasty. So, with that context, what are some potential alternatives? One is cash. Just keep cash in banks, checking accounts, savings accounts, certificates of deposit. The upside is there's no risk of principal loss, assuming your bank doesn't go under and you don't have more than the insurable limit, FDIC insurable limit. So no risk of principal loss. The downside is interest is still jokingly low. You can get now, today, early April 2022, 0.5% interest maybe in a high yield savings account. Certificates of deposits, you can get upwards of 1%. I saw recently some teaser rates, upwards of 1% for like a 1-year CD. You go out 2 and 3 years, you get a little more maybe, but still not anything to write home about, especially when inflation is 6 or 7 times that, right? So by keeping money in a bank account, you're guaranteed to not keep up with inflation. So you are ultimately losing money, losing purchasing power to inflation. So that's the downside about keeping it in cash. Maybe you want some of your money in cash, emergency fund if nothing else. But to go all in and pile your money into cash in lieu of bonds or other investments might be overdoing it. Next are I bonds, where the I stands for inflation. These are technically a bond, but functionally like a savings account that you get direct from the government through treasurydirect.gov. The upside of I bonds is you get a guaranteed rate of interest, similar to a savings account. You can't lose money. You'll get back what you put in plus interest. And the interest is directly keyed off of actual realized inflation. And that changes every 6 months. Specifically, every May 1st and November 1st, there's a new I bond rate announced based on what the actual change in the CPI, CPIU technically, was for the 6 months prior. Well, with inflation as high as it is now, the current annual interest rate on I bonds is 7.12%. The new rate to be announced in May, we don't yet know. I don't think it should be announced any day if it's not already. I should have checked before this video. But I'm almost certain that's going to be over 7% again based on how inflation has played out over the last handful of months. So that's the upside, high interest, guaranteed interest. Downside is you can only put in up to $10,000 per person. There's a few exceptions, like if you have a trust or a business, you can buy more under their names. But basically $10,000 per taxpayer ID, let's put it that way. Which isn't a tremendous amount. So you got $500,000 you're looking to do something with. You can't dump it all into I bonds in one shot. The other downside is there is a hard 12-month restriction around taking money out after you put money in. So you can't touch the money at all for the first 12 months you put it in. After that 1 year period, there's a small penalty between 1 and 5 years to take money out. Specifically, you have to give up the most recent 3 months of interest, which isn't that bad. That's a slap on the wrist, not much more than that. But it won't dip into your principal or anything. So that's I bonds. Cash-like better interest, but some other restrictions and twists and turns around it. Next will be MYGAs, MYGA, or multi-year guaranteed annuities. Technically annuities, these are contracts you buy from an insurance company, but functionally like CDs, certificates of deposit. You put money in, you have to commit to leave it there for a certain amount of time, 3 years, 5 years, 7 years, whatever term you choose. and you will get back at the end of that all of your principal plus whatever guaranteed interest rate there was stated at the time you entered that contract. So now this is all subject to change, but currently a 2-year MYGA, you can get about roughly 2% on it. I'm sorry, 1.5%, and then I'm gonna mess it up. No, like 2.5%. And then a 3-year you can get, I just checked the other day, now I'm conflating these numbers. A 3-year you can get, I think 3 years, 2.5%. Whatever. Look, you just Google current MYGA rates and you'll see between 2 to 5 year, you can get upwards of maybe 3%, I think. I want to say a 3-year was like 2.7%, give or take. So guaranteed, which is good. Still not great. I mean, still falling short of keeping up with inflation, but no principal loss. With a caveat, because these are annuities, there's a multi-year contract. If you sign up for a 5-year MYGA, multi-year guaranteed annuity, you're typically only allowed to take out up to 10% per year. If you take out more than that, there will be a surrender penalty. Those surrender penalties will eat into your principal, so you potentially get back less than you put in. So that's the downside of that. Another unique twist is if you're under 59.5 when your MYGA matures and you cash it out, the contract is over, you will have to not only pay tax on the interest, you have to pay a 10% early withdrawal penalty. So unless you're over 59.5 when it matures, keep that in mind, because you can't take the money out of the annuity world. You'd have to roll it into another MYGA or another annuity and keep deferring the realization of that income until after you're 59.5 if you want to avoid the 10% penalty. So that's a MYGA. Stable value fund is the next option. Now, this isn't applicable or available to everyone. These are only really available in an institutional investment plan, like if you have a 401k or the federal thrift savings plan, for example. A stable value fund is an account you can put money in within that plan. No principal loss, which is good, and it'll be some guaranteed rate of interest. So you'll get all your money back plus whatever the interest is. And you can typically put money and take money out. Maybe they limit you to once a quarter or something, but it's not going to be a multi-year thing. It's loosely like a high yield savings account if you want to think about it that way. So the upside, again, no principal loss, higher than bank account interest. Most stable value funds I've seen or heard of recently are paying 1.5% to 2% currently. So still not great, right? Not keeping up with inflation, but guaranteed to not lose any principal value. If you're a federal employee and you invest in the thrift savings plan, it's the G fund. It's synonymous with a stable value fund. You put money in, you can never get back less than you put in, and you'll get some guaranteed rate of interest that changes every month, I think. Currently, it's paying about 2.5% guaranteed interest, but again, subject to change month to month. So a good option. You don't necessarily go all in and put all of your bond money in there, maybe just a portion, right? Because the returns, while guaranteed, aren't high in absolute terms. The other one is the fixed indexed annuity. Now, this is a little different. These are complex. I do have links in the show notes to a more elaborate, more descriptive video I did about fixed index annuities. It'll make much more sense because there's a lot of moving parts to them. But this is a multi-year annuity, typically 5+ years, 10 or more, 12 years I've seen, where, long story short, you put money in, the interest you get will hover between 0 and some positive amount every year. And that positive amount is keyed off of the returns of some broad market index, typically like the S&P 500. You don't get all of the interest of the S&P 500, you get some portion of it. Realistic expectations, if you have a fixed index annuity and sit on it for the full, let's say 10 years, you can realistically expect low to mid-single digit returns on average over the life of that 10 years. So still nothing fantastic. Don't expect 7, 8, 9, 10%, but you will get something greater than 0. It'll be low to mid-single digits. So it's bond-like in that it's sort of slow and low, steady eddy kind of long-term, reasonable growth without downside risk. Now, because it's annuity, again, there's surrender penalties. If you take the money out prior to the length of your contract, be it 5-year, 7-year, 10-year, there will be surrender charges. If you take out more, then again, typically 10% per year. So keep that in mind. Next, so those, let's pause there for a moment. Those are sort of the most likely ones that you would actually come across or consider using as a bond-like equivalent in your portfolio. The next handful of options aren't really great equivalents. I'll put them out there just because you may have come across them or heard of them. Chances are not going to be the best in many situations. One is a structured note. There's different names for this, but basically this is just a bespoke custom contract you have with typically a large bank, global bank. We'll write you a custom contract that says if XYZ happens, we will pay you ABC. So you kind of have an IOU side bet with them. They'll say if the S&P 500 goes up at least 10%, we'll pay you 5% for the year. If it's negative for the year, we'll pay you 0, or if it's something in between, we'll pay you whatever. And these can be structured however. Now, if you hold it for the length of the contract, then yeah, you may get, mid-single digit returns or lower mid-single digit returns. Depends on the contract. So could potentially work. Downside is not very liquid. You can't get out of these things easily, or if you can, there's going to be some surrender penalty to it. You also take the risk of the bank who wrote the contract, because this is not a security. It's literally an unsecured kind of IOU from that bank. Not that that's a major concern with most banks, but still something to think about. So structured investments, structured notes, that's one possibility. Dividend paying stocks, or specifically even preferred preferred stocks that pay dividends. Could potentially be decent amounts of income in the form of a high dividend. Downside is it's not guaranteed in many cases. The dividends can be cut out completely or can be reduced if the company has troubles economically and doesn't have the cash flow to keep paying out these dividends. And with any investment, you have to look at your total return. It's not just the income you get from it, it's also the fluctuation in that security's price. So you may own some stock that's paying a decent dividend, but what if its price is going down every year for like a 10-year run? So the total return, net of whatever dividends you get minus whatever price decline there may be negative. You may be losing value in that security every year. But yes, it's throwing off a dividend, so there's that. So point is, don't look at just the dividend. You have to look at the total return. Though, if you do have good, stable stocks whose prices hold up well and pay dividends, on time and with consistency in terms of how much they pay, then that could be decent. But it's not, there's nothing contractual about dividends in many stocks. So you can't really view it the same as a bond, because bonds do have their interest payments needing to be made under contractual terms, guaranteed terms. Alternative investments. This one's really a stretch, not within the realm of reasonable for most people. But things like hedge funds, a lot of hedge funds, while not specifically bond-like strategies, they may have strategies that are designed to produce low and stable returns throughout the years. Not to say there won't be down years, not to say there won't be really good years, but generally some of them target just to get mid-single digit returns year to year. That's possible upside. Downside is not guaranteed. Other downside is there's usually large minimums to invest. There's usually redemption restrictions. You can only get money out once a month, once a quarter, whatever it may be. There could also be fees around your ability to get money out. The performance fees and management fees could be high, so not ideal, but point is the returns of certain alternative investments like certain hedge funds could be bond-like over the long term. Short term, anything can go, but longer term could make sense. And finally, cash value life insurance. This is a whole animal in and of itself. First and foremost, it's life insurance. Keep that in mind. It is not an investment. Cash value life insurance should never be viewed primarily as an investment, because it's not. And it's never going to be an apples to apples comparison, life insurance versus an investment. Cash value life insurance does have an investment-like component to it, in that some of the premiums you pay go toward paying the cost of the insurance itself. Some go towards paying policy fees, surrender charges perhaps if you leave early, and then the rest goes to a cash accumulation feature within the policy. Now, depending on the type of policy you have, that cash accumulation could be some guaranteed rate, like what's called whole life insurance goes up by a fixed rate every year, 3%, 4%, whatever it may be. Other ones like index universal life, the interest you get is like a fixed index annuity. The interest is keyed off of the returns of some financial market index, where typically the floor, the minimum interest you'll get is 0. The maximum is going to be some positive amount. So whole cash value life insurance is not a short-term fix if you're looking for a bond-like investment. These are really multiple year commitments. You need to put the money in, let it sit, let it bake. Because again, this is life insurance first and foremost, not investment. So a lot of what you're paying for is to buy the life insurance. Only a portion of the money you put in goes towards this investment-like cash accumulation feature. So it's going to take some time for the policy to get paid, or mostly paid, or sold, mainly paid, to pay the expenses in the policy, and then the cash value will start to build and compound over time. So maybe 5, 10, 20 years down the road, you may have some sizable cash value that's earning a steady, consistent 3 or 4% interest if it's a whole life policy. But that's not a quick fix. Again, I wouldn't view that as a bond replacement. I'm just putting it out there because some folks may pitch it or sell it as an investment or investment-like product when it has investment-like features, but it is definitely not investment. It's always first and foremost going to be life insurance. So that's that. Hopefully you found this helpful. As you can see, there's not a direct replacement for bonds. There's lots of things that sort of do, bits and pieces of what bonds do, but they all have their own unique pros and cons. So, think carefully before committing to rotating out of bonds into something else, like one of these things we talked about. All right, that's it. Take care. I'll see you next time.